Welcome back to Talk Nerdy to Me, a financial guide for entrepreneurs where we dive deep into the financial issues that small to mid-sized businesses and high-growth companies face. Then we explore practical solutions to overcome them. I'm Michelle Delker, founder and CEO of the Stanley CFO Group. Today, we're discussing a topic that's critical to the success of every business: cash flow management. It's the lifeblood of any company, and without proper management, even the most profitable business can find itself in trouble.
Cash flow management is a challenge that nearly every business faces at some point, whether due to late payments, unexpected expenses, or seasonal fluctuations. Managing cash flow effectively is essential not just to keep the lights on, but to seize growth opportunities when they arise.
Keep the lights on.
Yeah. Girl.
Otherwise, we need candles. So now we know that both profitable and unprofitable companies can face cash flow challenges. But today, we're going to focus on profitable companies. We'll focus on addressing companies that are operating at a loss in episode 5.
Can't wait.
Woo!
So today, we'll talk about cash flow challenges for profitable companies and explain why even profitable businesses can struggle with cash flow, and talk through what they can do to improve their cash position.
This seems to be a real head scratcher for many people. They think, oh, the business is profitable, it shouldn't have cash flow problems, but that's not always the case, right?
That's right, Michelle. A company can be profitable on paper, but still face cash flow issues. This often happens due to the timing mismatch between when revenue is recognized and when cash is actually received. For example, a company might have a large amount of sales on credit, meaning they've recognized revenue, but they haven't yet collected the cash. Additionally, rapid growth can strain cash flow, especially if a company needs to invest in inventory, equipment, or personnel before the cash from sales is collected.
I think that's a really important distinction. For profitable companies who are already optimizing their margins, the focus should be on expediting their cash conversion cycle, the time it takes to turn investments in inventory and other resources into cash flow from sales. By reducing the time it takes to collect receivables and managing payments more strategically, these businesses can improve their cash position without needing to bolster profitability.
Right. Another consideration for profitable companies is managing growth carefully. Rapid growth can be a double-edged sword. It brings in more business, but it also requires more upfront investment. To avoid cash crunches, it's important to forecast cash flow carefully and plan for those peaks and valleys that come with scaling up operations.
When you say forecast cash flow, I get little tingles because that's a hashtag Talk Nerdy to Me moment. Let's talk about the biggest opportunities to improve cash flow for profitable companies. Are you ready?
I'm ready.
I think the first one is improving accounts receivable management, really tightening up credit terms and following up promptly on late payments to expedite cash inflows. So this is where you need to consider implementing maybe an automated invoicing system to ensure consistent and timely billing. And this is something that might sound crazy, but I do regularly have to remind some of our vendors to invoice us.
You're right. I've seen the emails. You're begging to pay people. I don't get it.
Well, I know the vendor has already completed their commitment and it's time for them to be paid, but I haven't seen an invoice. And if you're sending an invoice 2 weeks late, you're probably going to get paid 2 weeks late. And there's just no reason for that. So automation, checks and balances, internal controls, all of the things. So there's that, accounts receivable, but then also accounts payable. So extending your accounts payable. And I don't mean doing anything nefarious. I don't mean not honoring your commitment. I mean negotiating market payment terms with suppliers to keep cash in the business longer. So if our publicly traded competitors are getting 45 or 60-day terms and ours are 15, there's probably something that we need to do. Now, if you're leveraging a prompt pay discount, that discount may be more advantageous compared to adhering to the market vendor terms. We'd need to compare the scenarios to determine what made the most sense. And these are great and very straightforward, but I know that you've got some more exciting things that you can share.
I do. We can monitor our inventory levels. Companies should avoid overstocking inventory, regularly assess inventory turnover rates to ensure that capital isn't tied up unnecessarily. Again, this requires good internal controls and planning to understand appropriate par levels and reordering rhythm and cadence.
I like the planning.
Yes.
And I like that you said par levels.
Par levels.
Yes.
We can also reinvest wisely. Be strategic about reinvestments. Focus on investments that will quickly generate positive cash flow or directly support your growth strategy. Avoid over-investing in areas that won't yield immediate returns. And you know what else?
What?
Let's do a pro forma with an expected return on investment, complete with payback time. You have to be thoughtful.
So facts, not feelings. You can have a feeling, but then pencil to paper or cursor to spreadsheet and really figuring out what's what.
There's always your gut, but yes, you need the data behind it.
Always your gut, but still use data. Okay, great. Those are fantastic insights. And these strategies highlight that managing cash flow effectively is about making smart financial decisions to optimize cash flow and ensure sustainability.
And this is where cash flow forecasting becomes crucial. Even when you're profitable, having a clear picture of your future cash inflows and outflows is essential. This allows you to anticipate shortfalls and take proactive steps to secure financing or adjust operations.
Did you turn on your sexy voice when you said cash flow forecasting becomes crucial?
This is just natural.
Oh my gosh, now she's bragging. All right, so I agree with you. One of the most effective tools for this is a 13-week rolling cash forecast.
Dave.
Oh, yes. It provides you with a detailed view of your cash flow week by week for 3 months. And it allows you to see where potential cash shortages might occur and helps you make adjustments well in advance.
13-week rolling forecast is particularly useful because it's dynamic. Each week you update the forecast based on actual cash inflows and outflows, which helps you stay on top of your financial situation and adjust your strategy as needed. It's a proactive approach that gives businesses the flexibility to adapt to changes quickly.
Rapido. And we know that there are other tools too, like scenario planning and sensitivity analysis. They can help you understand how different variables, like changes in sales volume or expenses, can impact your cash flow. Modeling these different scenarios can better prepare you for potential challenges and help identify opportunities to strengthen your cash position.
Right. And combining these tools provide a comprehensive view of your overall financial health, facilitating more informed decision-making. For example, if your 13-week forecast shows a potential cash shortfall, scenario planning can help you explore various strategies to mitigate the impact, such as delaying non-essential expenses, accelerating collections, or negotiating better payment terms with suppliers.
Oh my gosh, this has been a lot of really helpful information, but I think we need to take it back to a real world example. Do you remember last episode's financial diagnostic? The entrepreneur with the wellness facilities?
I do.
He had the bloated conversion cycle.
Yes.
So bloated. Can we pull his information back up?
Try to stop me.
Try to stop her, people. She's very excited. Scrappy. Okay, so let's refresh our memory. This gentleman's company had declining profitability and a significantly bloated conversion cycle compared to his trending, as well as compared to publicly traded competitors. Super tight, leveraging debt with limited ability to invest in growth. Definitely felt like we were missing some opportunities. And we knew that there were a handful of things that we could do to tighten his cash position. So we did them. Robin, what did we do?
All the things. We count on past due invoices facilitating payment, reached out to our vendors to negotiate market payment terms. We were not receiving a prompt pay discount, so extending the terms did not have a negative economic impact. And we evaluated the composition of the inventory balance. Turns out we'd stopped using certain items but hadn't attempted to sell them from inventory. But after identifying them and talking with the entrepreneur, he was able to sell them at his book value. And we promptly put an inventory program, including ordering protocol with applicable par levels and internal controls, regular inventory counts, and a monthly inventory reconciliation. Presto bingo.
Presto bingo. My gosh, I love it. So here was his conversion cycle before, and here is his conversion cycle now. And this is a staggering improvement. When we look at how this gentleman's conversion cycle trended previously, we saw exponential growth, which is what we're referring to as bloat. So the cycle went from 20 to 40 to 60 to 80 days. And we wondered, where is it going to stop? Because our publicly traded competitors were sitting between 18 and 30 days, so significantly less.
Big difference.
Huge difference, right? And the things that we did were very straightforward. It was the basic blocking and tackling that we just covered, but it's not quite good enough. There is still more that we need to do. And I think really drilling down into how expediting that conversion cycle helped the business in other areas is going to better articulate why it's so important to improve the velocity of your cash flow. Can we do it?
Let's do it.
My gosh, I'm so excited. All right, so now we're looking at the balance sheet. And there's a column that shows us what our balances were on the balance sheet as of the end of 2023. And then next to that, there's a column that shows us what our balances are at the end of June of 2024. When I look at this, I can see a couple of things that are really impactful. You too?
Yes. Sure.
She answered quickly. All right. What I see is that the accounts receivable balance went down. So that means we collected more. Our inventory balance went down significantly. So that's where we identified items that were no longer being used and we were able to liquidate them at book value, which is great. Our accounts payable went up a little bit. So that's where we negotiated with our vendors and we were able to pick up a couple of days afloat. We paid off our line of credit.
Look at that.
Oh my gosh, that's fantastic because I think it was running all in around 13%. And then do you see this change in fixed assets?
Oh, what's going on there?
I feel like we might be expanding operations. We're investing in growth. And again, nothing changed with profitability. This is just the timing of the cash. And so we eyeballed it here, right? But there's no need to do public math. Why?
We can look at the statement of cash flows.
Remind us again.
Oh, what is that?
The statement of cash flows.
It's the net income from your income statement back down to your cash on the balance sheet.
Yes. So it's all the puts and takes that walk from your net income or loss to your ending cash balance on your balance sheet. And so here, the math is done for us. We can see that accounts receivable has improved by almost $800,000, inventory by $1.2 million. So that's $2 million of additional cash flows that came in, which allowed us to invest in that growth. Looks like right now as we're building our 5th facility, we've invested $1.2 million. We've also paid off our line of credit, which is huge. It's going to reduce our interest expense. And this is an S Corp, so it looks here like we made distributions for taxes.
It looks good.
I'm feeling very good. But again, I want to do more because I know this build is going to be like $6 million. And we would love to be able to finance that through existing operations as opposed to leveraging external debt.
Definitely in this climate, in this market.
This climate, put on the sunscreen, she says. Those rates are high. All right, but that's not all that we did. I know we also instituted a 13-week rolling cash forecast.
Should we share it?
Please.
Dun, dun, dun.
Dun, dun, dun.
All right, so this is my favorite, the 13-week rolling cash forecast. There's substance and form that's going on here. So form, you have your 13 weeks going across the top. And then it kind of mirrors your P&L or your income statement. So you have outflows and inflows. So your inflows, think of it like your revenue, that cash that you're getting for that revenue. And you can see it's not the same every week. It pops up, it pops down. So it all depends on how we're collecting those dollars for that revenue that we've generated. The next line is also money coming in. Remember, we talked about him liquidating his inventory at cash or his book value. He keeps selling it. He's doing great.
So every month when they're reconciling, they're identifying little bits that they're, okay.
And he's not ordering more just to make the shelves look pretty.
Bless his heart.
And then as you go down, you start to have your outflows, money going out the door. You know, we don't like that, but it's part of running business. We can't hold on to all the money. So we have to pay for the cost of goods sold that we're using to produce that revenue that's really driving the business. And you have your payroll.
Oh, not payroll.
That's a very big expense for almost any company. Mm-hmm. And if you kind of look across, you'll see in July, it looks like they paid out a bonus. I believe he does quarterly bonuses for his staff, which is amazing.
So lovely.
Sounds
Invest
like
in your team.
Great place to work, right? And then we have our other expenses that are kind of coming through. Your travel, your insurance expense, it looks like maybe that's a one time a year type situation. So even though you're spreading the expense over your P&L throughout the year for financial purposes, you are paying all of that at once. So that is cash out the door, like as is.
Well, and I think that's why this tool is so important, right? Because we're looking at accrual-based financial statements, but we know that the cash isn't moving harmoniously with that. And this is what allows us to be positioned.
Correct. Okay. Yeah. So professional fees, advertising expenses, looks like it's once a month. IT expenses, once a month. Little hefty IT expenses. Rent, how often do you pay your mortgage? Once a month. So it's not like you're spreading this out over every week. So you kind of have to pay attention to which weeks the big payments are going out. Mm-hmm. As you're going down, I see something that may not necessarily affect the P&L right now, but it is going to lessen our cash. And it's that new facility build that we were talking about.
My gosh.
So we're bringing cash in and we're sending it out to build this new facility. And we're not going to see returns onto that new facility until we open it, start producing the revenue and all the fun stuff that goes along with that.
Yeah.
The line of credit has been paid off. Currently, looks like we're not going to utilize the line of credit. We're going to exist with current cash flows. And then tax distributions. It looks like we've distributed what we needed to for tax. So with that being said, you come down to like that second section where it says total inflows, total outflows. This is just summing up all that information at a detailed level. So you can say inflows minus outflows is your activity for each week. So you'll see that some weeks more cash is coming in than going out, or more cash is going out than coming in. So that's why it's kind of important to look at like this, because you can't have several weeks where it's flipped the wrong way. You need to kind of gauge and see when you can push or when you can pay the various things, and if you need to collect sooner. So in that third section, you're going to have your beginning bank balance. So this is you log into whatever bank institution you have and you see your daily balance. This is what you have. But the way I think about it is, maybe I've paid some bills and those bills haven't cleared, like even my personal checking account. I know at the end of the month, I may have a nice healthy balance, but I know as soon as the day changes, that mortgage is going to go out. So you kind of have to think about your commitments that you've already sent out the door that haven't necessarily cleared the bank. So those are your reconciling items, and that should get you back to your GL balance of your cash balance on the balance sheet.
This is fantastic. And I think that's a really important point that you just made, because I've seen some folks prepare a 13-week rolling cash forecast and tie it back to the GL with no mention or contemplation of the bank balance, which we have to consider both, right?
For sure.
Okay. And walking through this the way that you did, like full disclosure, she made fun of me and how, what did you say, noisy this document was?
But it's very busy.
There's a lot going on, she says, which is why I don't often do my own stunts anymore, right? Have professional help to assist. But with this level of granularity, it really helps us determine what adjustments we can make if we need to. So you talked about the timing of the customer payments, and there is some variability and volatility there that we have to contemplate as we're estimating. This is why, number one, it's so important to use our trending information. So to go back 6, 12, 18 months and look at the timing, the rhythm and cadence of those payments. That's going to help us with that. And then also, if payments come in less than what we anticipated, it gives us an opportunity to adjust some corresponding outflows, right?
Right.
So on this, payroll is non-negotiable. That's always going to be paid. But we could potentially slow the new build that we've got underway. If we're too tight, we could draw against that line of credit.
That we paid off so beautifully.
We did such a good job. Or we could go back and have an additional conversation with our vendors, because when I look at our publicly traded competitors, I can see that their days sales outstanding and their days payables outstanding.
Pretty close.
Almost a 1-for-1 match, which means all they're floating is their inventory. And for us, we've still got roughly 20 days of float on the cycle just related to that. So there's definitely opportunity. Well, I think you did a beautiful job. Absolutely fantastic. And to me, it's so amazing that we're now investing in growth, building out that 5th wellness facility and financing it through existing operations cash flow. That's the dream.
Yes. If it could all be like that.
Yes. And no surprises. This forecast has given us a great line of sight, letting us maintain smooth operations and seize additional growth opportunities. So with everything that we've looked at, all the tactics we've deployed, they all speak to optimizing our cash flow, investing in growth, and honestly fortifying the business for ongoing success.
It's all right here. And other folks can do the same thing, right? Pull their historicals, trend it, and then pull in the comps to determine how many days cash on hand are other folks running. What's their debt ratio? Because looking at these publicly traded competitors provides us with insight into both best practices and potential risk.
Chica, I'm exhausted. Are you tired?
I'm always tired. You wear me out.
Wear her out. Thank you for still coming back.
Oh, you're welcome.
And also, thank goodness we have coffee. So this episode is a perfect segue for our next episode. In our next episode, we'll have special guest David Mastrorio, who is the Chief Lending Officer of DFCU. He'll set expectations for a successful partnership with a financial institution. He'll talk about how Treasury partners can help businesses navigate various challenges. And he'll explore several Treasury solutions for financing and working capital needs. So, if you're looking to better understand how to leverage these partnerships to optimize your cash flow and support your business's growth, make sure to tune in.
We hope you found today's episode on cash flow and working capital helpful. Remember, managing your cash flow and working capital effectively isn't just about survival. It's about positioning your business for growth.
Thanks for joining us on this episode of Talk Nerdy to Me. As always, we'd love to hear from you. So subscribe to our podcast, share it with your network, and leave us feedback. Also, feel free to watch just to make fun of us. You can reach us at thewilliamstanleycfogroup.com. Let us know what topics you'd like us to cover or any questions you might have. Until then, keep nerding out. Okay, bye.